and welcome. Are you looking for an indicator that is widely used to assist in identifying early trend changes? Yes, you are. And what you're looking for is the MACD. It is used for overbought and oversold signals as well, much like the RSI, but that wasn't the original reason why it became so popular. MACD is an acronym for Moving Average Convergence Divergence. This tool is used to identify moving averages that are indicating a new trend, whether it's bullish or bearish. After all, our top priority in trading is being able to find a trend because that is where most of the money is made.
The MACD was invented in the 60s by Gerald Apple and is one of the most widely used indicators in technical analysis today. People choose to use it because it's relatively simple and can be used to figure out the trend and can be used as a momentum indicator. The MACD is based on moving averages or lagging indicators for the sake of trend following characteristics. It doesn't work off a percentage range of 0 to 100%, but rather its moving oscillations are plotted on a centered plot line up to infinity. MACD works on all chart time frames like all other indicators. The only difference is the length of time it takes to form the triggers and moves. Nonetheless, you need to start studying all these through live market observation.
With a MACD chart, you will usually see three numbers that are used for its settings. The first is the number of periods that is used to calculate the faster moving average. The second is the number of periods that is used in the slower moving average. And the third is the number of bars that is used to calculate the moving average of the difference between the faster and slower moving average. For example, if you were to see 12, 26, 9 as the MACD parameters, which is usually the default settings, this is how you will interpret it. The 12 represents the previous 12 bars of the faster moving average. The 26 represents previous 26 bars of the slower moving average. The 9 represents the previous 9 bars of the difference between the two moving averages. This is plotted by vertical lines called a histogram, the blue lines in the chart above.
There is a common misconception when it comes to the lines of the MACD. The two lines that are drawn are not moving averages of the price. Instead, they are the moving averages of the difference between the two moving averages.
The MACD consists of three elements. An oscillator exponential line that is calculated by averaging out the difference between a currency pair's 26 period and 12 period EMA. The oscillator oscillates back and forth across the zero line. The trigger line, which is usually plotted alongside the oscillator line to act as a trigger. The most popular setting is a 9 period exponential moving average. And lastly, the histogram, depiction of the difference between the MACD oscillator line and its trigger 9-day EMA.
The histogram is positive when the MACD is above its 9-day EMA and negative when the MACD is below its 9-day EMA. If prices are rising, the histogram grows larger as the spread of the price movement accelerates and contracts as the price movement decelerates. The same principle works on reverse as prices are falling. MACD is most useful when prices are trending. Most indicators only indicate signals in trending, not ranging markets. MACD is flat, confirming that the market is currently ranging. In these conditions, the MACD signals are unreliable. You need to be able to interpret crossovers when using the MACD. When the MACD falls below the signal line, it is a sell trigger signal and vice versa. Many traders wait for a confirmed cross above the signal line before entering into a position to avoid getting faked out or entering too early. You need to understand the divergence of MACD. When the currency pair's price diverges from the MACD, it signals the end of the current price wave movement and is a possible reversal of prices. The MACD signals are generally far stronger if there is a divergence on the MACD line or a large swing above or below the zero line. Unless there is a divergence, do not go long if the signal is above the zero line, nor go short when the signal is below the zero line. When the MACD rises dramatically, i.e. the shorter term moving average pulls away from the longer term moving average, it's a signal that the currency pair is overbought and will soon return to normal levels. When the MACD is above zero, the short term average is above the long term average, which signals upward momentum. The same goes when the MACD is below zero.
The MACD enables easy demonstration of the relationship between two exponential examples of the moving average. It is used as a means of showing the differences between both the fast and slow exponential moving averages of closing prices.
Now we will plot the custom MACD that you will find in Forex Central on our website. Go up to your indicator shortcut, go down to custom, and pick your MACD traditional. We will go over to our inputs tab, where we will ensure our fast, slow, and single periods are 12, 26, and 9 respectively. Then we'll move over to our colors tab. The fast EMA, which is green, we will change to orange. The slow EMA, which is red, will change to magenta. And the signal, which is blue, will stay blue, but we will change the thickness of our bars. And voila! Your MACD is plotted against your chart. Now you can add other indicators and have your tools integrated.
In our example above, the faster moving average is the moving average of the difference between the 12 and 26 period moving averages. The slow moving average plots the average of the previous MACD line. Once again, from our example above, this would be a 9-period moving average. This means that we are taking the average of the last 9 periods of the faster MACD line and plotting it as our slower moving average. This smoothens out the original line even more, which gives us a more accurate line. The histogram simply plots the difference between the fast and slow moving average. If you look at our original chart, you can see that as the two moving averages separate, the histogram gets bigger. This is called divergence because the faster moving average is diverging or moving away from the slower moving average. As the moving averages get closer to each other, the histogram gets smaller. This is called convergence because the faster moving average is converging or getting closer to the slower moving average.
Generally, it is considered that when the MACD falls below the signal line, it can be regarded as bearish and may well indicate a time to sell. Whereas when the MACD rises above the signal line indicating a bullish trend, that may indicate an upward trend in price. Because there are two moving averages with different speeds, the faster one will obviously be quicker to react to price movement than the slow one. When a new trend occurs, the fast line will react first and eventually cross the slower line. When this crossover occurs and the first line starts to diverge or move away from the slower line, it often indicates that a new trend has formed.
From the chart above, you can see that the fast line crossed under the slow line and correctly identified a new downtrend. Notice that when the lines cross, the histogram temporarily disappears. This is because the difference between the lines at the time of the cross is zero. As the downtrend begins and the fast line diverges away from the slow line, the histogram gets bigger, which is a good indication of a strong trend. There is one drawback to MACD. Naturally, moving averages tend to lag behind price. After all, it's just an average of historical prices. Since the MACD represents moving averages of other moving averages and is smoothed out by another moving average, you can imagine that there is quite a bit of lag. However, MACD is still one of the most favored tools by many traders.
The secret treasure chest to successful trading is to be able to achieve an early forecast of a price wave in the direction of higher trends, before or as it is forming, as opposed to reacting to one as it is ending. The technique of doing so is to find tools that will give you the earliest indication of a possible reversal. Amongst other technical tools, the MACD is one of them. The main challenge is to learn to tell the difference between a market that is trending and a market that is ranging. So you have to gain experience through watching the live market as much as possible.